Welcome back. Today we're diving into master limited partnerships, MLPs, a powerful but often overlooked way to boost your investment income. MLPs are unique, mostly energy-focused investments known for high distributions and attractive tax advantages. With market volatility and shifting interest rates, stable, high-yield options like MLPs are more important than ever. I'll break down what MLPs are, how they work, and share my top high-yield picks for 2025. Let's get started. Let's break down master limited partnerships, often referred to by their acronym or MLPs. These are a unique investment vehicle, and understanding their structure is key. An MLP is essentially a publicly traded partnership, meaning it's listed on major stock exchanges just like any other company. They primarily operate in the energy sector, focusing on infrastructure and resource transportation. This allows you to buy and sell units, similar to shares of stock, offering liquidity and accessibility. When you invest in an MLP, you become a limited partner, gaining a stake in the partnership's earnings. As a limited partner, you're essentially a passive investor, meaning you don't participate in the day-to-day operations. Instead, the general partner takes on the responsibility of running the business and making strategic decisions. The MLP structure exists for one big reason, and it's a significant advantage for investors' taxes. Specifically, the way MLPs are treated under tax law. MLPs are structured as pass-through entities, a key feature that sets them apart from traditional corporations. This means they don't pay corporate income tax at the entity level, avoiding a major expense. Instead, profits and losses flow directly to you, the investor, as if you were a direct owner of the underlying assets. This mechanism is crucial because it avoids double taxation, which occurs when profits are taxed at both the corporate and individual levels. This tax efficiency means more cash is available for distributions to the partners, which is a primary reason why MLP yields are often much higher than those of other investments. They typically offer more attractive returns than regular stocks or bonds, making them appealing for income-seeking investors. Most MLPs operate in the midstream energy space, a critical segment of the energy value chain. This includes pipelines, which transport oil and natural gas across vast distances, also storage facilities, which hold these resources until they are needed, and finally, processing facilities, which refine and prepare the resources for end use. Their business model is often compared to a toll road. They get paid based on the volume of oil or gas moved through their infrastructure, not the price of the commodities themselves. This makes their cash flows more stable and predictable compared to companies directly involved in exploration and production, even when commodity prices experience significant swings and volatility. The government created MLPs to encourage investment in critical energy infrastructure, recognizing its importance to the economy. As a result, they're legally required to pay out most of their available cash flow to investors in the form of distributions. That's why MLPs are often referred to as cash flow machines, designed to generate substantial income for their investors. They are specifically built to deliver consistent, high distributions, making them attractive for income-focused portfolios. In short, MLPs offer the potential for high, steady income, a key benefit for many investors. They also provide tax advantages, thanks to their pass-through structure. And finally, they offer exposure to essential energy infrastructure, a vital part of the modern economy. But as with any investment, it's crucial to understand that there are trade-offs and potential risks involved. Next, let's talk about the pros and cons of investing in MLPs, weighing the advantages against the potential drawbacks. And of course, we'll delve into the infamous K-1 tax form, which is a unique aspect of MLP investing. Stick around, there's much more to learn about these interesting investment vehicles. This is where it gets interesting as we uncover the nuances and complexities of MLPs. MLPs, or master limited partnerships, offer high yields, often 6% to 10% or more, making them particularly attractive for income-focused investors seeking a steady stream of cash flow. These yields can significantly boost your investment portfolio's overall return. Their unique tax structure means that most of the distributions you receive are classified as return of capital, letting you defer paying taxes on that income until you eventually sell your MLP units. This can be a significant advantage, allowing your investment to grow tax-deferred over time. But here's the catch. Instead of the simpler 1099 form, you'll receive a K-1 form at tax time. K-1s are notoriously complex, often arrive late in the tax season, and can potentially make your tax filing process a real headache. requiring extra time and possibly professional assistance. Most MLPs are heavily concentrated in the energy midstream sector, which includes pipelines and storage facilities. So by investing in MLPs, you're essentially making a focused bet on the continued health and stability of that specific industry. Rising interest rates can also negatively impact MLP prices, since investors may find safer government or corporate bonds more appealing as their yields become more competitive. Furthermore, the partnership structure itself can sometimes create conflicts of interest between the general partners, who manage the MLP, and the limited partners, who are the investors. This is especially true if the management team prioritizes aggressive, risky growth strategies over stable, sustainable returns for investors. In short, MLPs definitely have the potential to supercharge your income stream, but they come with inherent tax complexity, significant sector-specific risk, and therefore, the absolute need for thorough and careful research before investing. If you're willing to diligently handle the extra paperwork and navigate the potential market volatility, the potential financial rewards can indeed be well worth the effort. But whatever you do, don't go in blind. Make sure you fully understand exactly what you're signing up for before committing your capital. Next, let's talk about how to spot the best MLPs in the market. Because frankly, not all MLPs are created equal in terms of financial strength and stability. You absolutely need to be able to separate the financially strong and well-managed MLPs from the potentially risky ones. So let's get into the key financial metrics that really matter when evaluating an MLP. This is precisely where smart and informed investors gain a significant edge. Ready to dive in? Let's go. Not all MLPs are safe bets. Here's how to spot the winners. First, check the distribution coverage ratio, DCR. A DCR above 1.2 means the company generates more cash than it pays out, a crucial safety cushion. Next, look at the debt to EBITDA ratio. For midstream MLPs, under 4.5 is good, under 4 is even better. High debt means higher risk. Don't just chase the highest yield. Compare yields to historical averages and peers. A sky-high yield can signal trouble ahead. Dig into the business model. Are revenues from long-term fee-based contracts with strong customers? That's what you want. Location matters. Assets in top-producing regions like the Permian Basin are more valuable. Read investor presentations for details on contracts, customers, and asset quality. In short, focus on coverage, debt yield context, and business fundamentals. Do your homework, and you'll avoid most of the landmines. Now, let's zoom out and see what's shaping the MLP market for 2025. The landscape is changing. Here's what you need to know. The MLP sector has undergone a significant transformation, a real evolution in its structure and approach. Today's leaders are not just more disciplined, but also demonstrably more financially healthy than their counterparts from a decade ago. They've learned from past cycles. Companies are laser-focused on paying down debt, reducing their leverage, and strengthening their balance sheets for long-term stability. They are also dedicated to optimizing existing assets, ensuring they are running efficiently and generating maximum value. And importantly, they are committed to returning cash to investors through dividends and other distributions. Big, expansive new pipelines are increasingly rare. The era of massive infrastructure builds is largely behind us. Instead, the focus is squarely on efficiency gains and smaller, more targeted, high-return projects that can be brought online quickly. Consolidation is a major trend that's reshaping the MLP landscape. Stronger, more financially sound MLPs are actively acquiring weaker ones, leading to the creation of larger, more resilient, and diversified players in the market. The fundamental backdrop remains supportive, with demand for U.S. oil and natural gas continuing to be robust, both domestically and internationally. This is especially true given the significant global push for LNG exports, where the U.S. is becoming a key supplier. Consequently, existing pipeline infrastructure is more valuable than ever before, representing a critical piece of the energy value chain. Building new pipelines is an increasingly tough proposition due to stringent and complex regulations, adding to the scarcity value of existing assets. This inherent scarcity significantly boosts the value of current assets and provides strong support for stable and predictable cash flows. Despite these positive factors, MLPs are still relatively underowned by the broader market, meaning valuations remain reasonable and attractive. This presents a compelling opportunity, particularly for value-focused investors seeking long-term income and capital appreciation. Looking ahead to 2025, we can expect a continuation of the trends we've discussed. Disciplined capital allocation, further consolidation within the sector, and sustained strong demand, driven in large part by the growing global demand for LNG exports. The regulatory environment will likely remain challenging for new projects, creating hurdles for new entrants. However, that regulatory difficulty effectively creates a competitive moat for the existing players, protecting their market share and profitability. Bottom line, the overall setup for MLPs in 2025 looks quite strong, offering attractive opportunities for investment. The key, as always, is to pick wisely, focusing on the best managed and most strategically positioned companies. Now, let's get specific and dive into my top MLP picks for the year ahead, where I'll share my specific investment recommendations. Here are my top MLP picks for 2025. Remember, this isn't financial advice, just ideas to research. First, Enterprise Products Partners, EPD, the blue chip of MLPs. Massive, diversified, with a fortress balance sheet and a 25-year streak of distribution increases. Yield isn't the highest, but it's rock solid. Next, Energy Transfer, ET. Higher yield, more aggressive history, but management has improved the balance sheet and coverage. If you believe in the turnaround, ET offers high yield and upside. MPLX, backed by Marathon Petroleum, strong assets in natural gas and crude, solid coverage, and a history of buybacks. Great for those seeking both yield and stability. Western Midstream, UES, focused on the Permian Basin, strong alignment with Occidental Petroleum, low debt, and a well-covered yield. Each of these has strong coverage, manageable debt, and solid business fundamentals. Do your own research, but these are great starting points for a high-yield MLP watchlist. Next, let's talk about building a smart MLP portfolio. Diversification is key, even in this niche. Don't put all your eggs in one basket. Build a diversified MLP portfolio. Mix asset types. Own a giant like EPD, add a natural gas-focused name like MPLX, and a crude oil specialist like WES. This spreads your risk across different parts of the energy chain and regions. Limit any single MLP to no more than 5% of your total portfolio, and no more than 25 to 30% of your MLP allocation. If you want simplicity and hate K1 forms, consider MLP ETFs like AMLP or MLPA. ETFs give you instant diversification and a simple 1099 at tax time, but you'll pay higher fees and lose some tax benefits. Direct ownership offers better tax efficiency and higher potential returns, but requires more homework and paperwork. Choose the approach that fits your goals and tolerance for complexity. For many, a mix of direct holdings and an ETF can work well. Before you invest, avoid these common MLP mistakes. Don't chase the highest yield. Extreme yields usually mean trouble is coming. Always check debt levels. High leverage is a red flag. Don't buy MLPs in retirement accounts without understanding UBTI tax risks. Monitor your holdings. Review earnings and coverage ratios each quarter. Don't expect tech stock growth. MLPs are for steady income, not big capital gains. Don't panic during volatility. If you've picked quality, downturns are often buying opportunities. Recap. Avoid chasing yield, ignoring debt, misusing retirement accounts, neglecting monitoring, expecting fast growth, and panic selling. Stick to these rules and you'll be ahead of most investors in the MLP space. That's your crash course on MLPs and my top picks for 2025. Remember, focus on quality, do your homework, and invest according to your goals and risk tolerance. The landscape changes, so keep learning and stay curious. Drop your questions or favorite MLPs in the comments. I read everyone. Thanks for watching. Subscribe for more smart investing content.